buying something at today's value and it's then going to be built in 12, 24 months, just through the price of construction, the price is going up. Hello, everybody. This is another Wealthy podcast with the great King Louis. Mate, thank you for joining the show today.
I appreciate the kind words, Dominic. I appreciate them.
So everybody out there that is watching, listening to the show, today we're going to be talking about what is going on in the real estate market. At the start of this year, it was total residential real estate market was worth $8 trillion. And at the end of this year is predicted to get to $9 trillion. So that's a big change in price. I want to talk to all of you about that. I want to talk to you about what we're seeing in the market. There's some very interesting market data coming out of CoreLogic. ABS, the Australian Bureau of Statistics, have been giving us some interesting statistics on lending, borrowing rates, who's been coming into the market. And we also want to talk about some supply and demand, what's happening on the supply side, as well as what's been happening in the market at large. So, Louis, just to add a bit of context, people out there listening are going, great, $8 trillion, kind of, who gives a shit? What does that actually mean? Like, can you add some context of what $8 or $9 trillion means relative to the other investments in the Australian market?
If you look at the supermarket, stocks market, and the commercial real estate market, all three of these, if you combine all three of these worths, you still won't get the value of $9 trillion, which is the predictive end result of the Australian property market by the Australian residential property market by the end of this year. So if we look back at some stats and markets like the stock market or the superannuation market, and it is hard to, for anyone, for any day, an investor or even an analyst, if you don't have a strong economic or financial background, whether or not you studied at university, whether or not you live and breathe by the way, the finance, the backbone of our country regarding finance works, then it can be hard to understand. But an easy way to put it, it is the biggest and strongest, most powerful investment market or market in the Australian economy.
Yeah, and you said some really important things there. So nearly $9 trillion by the end of the year. Australian superannuation, all of our super amounts to a little over $3 trillion. So it's 3 times larger than superannuation. The Australian stock market is worth about 2.8, so just shy of 3 trillion. And then all of the commercial real estate is just under $1 trillion. Now, one thing that I found very interesting is a lot of clients, a lot of YouTubers, YouTube commenters will comment and say, hey, we're too highly leveraged as a country. There's too much debt. There's too much money owed to banks. Now, there's one statistic that really came out to me, and it was that there is $1.9 trillion of outstanding mortgage debt. And what that essentially means is $1.9 trillion where people are paying interest on that debt. So if you put it into perspective, that is about a debt to equity ratio of 20%. So 80% equity, 20% debt. That isn't, in my mind, that high. I could be misunderstanding this, but when you look at those numbers, it doesn't feel as crazy as people assume. So, no. There's a lot of naysayers saying, oh, if interest rates go up, what's going to happen? Fire sales. Firstly, I don't think interest rates are going to go up anytime soon. And if they were, it's $1.9 trillion worth of outstanding debt relative to $9 trillion worth of actual asset. So
I was quite surprised by that, Dom, when I thought we would be much more of especially in the residential property market, that would be more debt leverage. But to see that we're, almost 7 times, or 6 times the amount of equity to debt, I was actually quite fascinated. It's not a figure I knew before reading this when the stats came out, and it's a figure that probably surprises the everyday people, because we do hear a lot of negative connotation about debt in the economy, or we do hear media is very driven by how much debt we're taking on or how much we're spending and debt we're acquiring. So to hear that, the everyday Australian and the everyday household is paying down their debt and actually is owning, more than 80% of the assets in the country, well, then I don't know, it's a good sign of faith or it's also a good rebuttal against, as you said, the naysayers for interest rates, if they're on the move and what's going to happen, the back end of this year moving into next.
Yeah, it's some really stable feet underneath us. I'd be terrified if it was the other way around.
Yeah, you see economic crashes, but to our point, it's it set our economy up for not if there was a fall or if there was a rise in interest rates, but we've got a really good structural integrity to our to the residential real estate market.
I completely agree. Now, there's a few things that we talk about, Louis, and one of them is supply and demand, right? It's all well and good. The market has been running, and there are some early indicators that it's slowing down. It is still growing, but it's slowing down a little bit. One thing I want to talk to you about is that recent report that came from CoreLogic. Again, Eliza Owen put out this, so shout out to Eliza, that Australia's dwelling sales to new listings ratio has hit 1.4. Now, for all of you out there listening, now let me just make that a little bit simpler. When the ratio is 1, it implies that demand and advertised supply is balanced. So every one bit of property that gets listed, there's one person ready to buy it. So it's basically parity. Normally, the Australian market runs at 0.9%. So there's a little bit more people that are listing than buying. So that means that it's in favor of the buyers. That means, there are more people listing than there are people buying. Today, currently in Australia, it is 1.4, meaning that there are way more people buying than there are people selling. There are some interesting outliers like Adelaide, where for every one property that's listed, there are 2 people that are buying. And it's just fascinating to me looking at this data because we're in COVID, it makes sense because, that there are a lot of people that aren't putting their properties up for sale, and also, all-time low interest rates. People are spending less money on discretionary spending. So it's all-time high savings. But you know what I mean? It feels like a surprise to me. It's telling me that there's a lot of steam left in the market. There's still a lot of pent-up demand. And coming out of this lock-up phase, I feel like there's going to be an increase in listings, but there will be certainly a surge in sales too. What do you get from all that?
It contests the idea that it's not the biggest thing that we probably face today, or the biggest question we get, and I personally get asked, is that is the market boom at the moment held up not organically? Has it been implemented by the government to a certain degree? It most certainly has. Like I would 100% agree with that. We saw a lot of incentives, a lot of movement for the government, for the first home buyers, and just for the investors and the property market itself to really, hold up the economy during our tough times. But it takes us to really break down these numbers here, and you look at and you read these numbers and you look at them and you tear them apart. And I was watching Moneyball the other night, and it's a great flick about statistics, data, and what can be broken down and the holes you can see. And when you break this data down, it shows you that, or it provides a small argument to say that yes, there has been non-organic growth, and it's been stimulated by the government, but also at the same time, there's still buyer demand and low levels of stock. And when we break down these figures and we say that look, there isn't the stock levels are low to buy ratio, well, we're going to see some demand for prices, and price growth is going to, so subsequently, be a result of this.
Yeah, it's what you just said there. We saw it, right? We saw that the government incentivized for people to have first home buyers to enter the market. They created a whole bunch of home builder incentives, and then the ABS data reflected that. We saw a lot of first home buyers come in, first home buyer loans get approved. But then beginning of this year or beginning to middle of this year, a lot of the first home buyers slowed down. We saw more owner occupiers come in, but we're seeing a big growth in investors. You know, you and I talk about ABS data, and I love jumping into that. One thing that stood out to me was that we anticipated this would happen, but I'll explain what it is. The first home buy slowed down, the owner occupiers slowed down. So the lending at largely has slowed, but it's the investors are 100% higher than this time last year. So there are 100% more investors getting loans, buying property this year compared to last year. As a total, it's 86% higher, the amount of people that are buying properties. So again, there's a huge amount of people that are out there buying properties, getting approvals. And now we're starting to see investors compete with owner occupiers. So this is that demand cycle thing. We're seeing more people step into the market. I think it will slow down, but I don't know if I still think there's going to be a strong end to this year.
I think so too. I think the class, I said to you yesterday, Dom, I think the class of 2020, first home buyers or first property buyers, some investors, some, you know, let's put them in the class of the first home buyers of 2020. I think they won out of this. I think they took they took a risk, and the risk is most certainly by now paid off for sure. That's probably, I don't think anybody on the internet, anybody in the media can deny that if you bought and if you got all the schemes the government offered, and you bought your first home, if you bought your first home the back end of last year and you bought it well, then I don't think you have had anything to worry about over the past 8 months. But the question is, as to your point, Dom, is where we go from here as I think the next turn or the next series of winners, the class of 2021, say quarter 3, quarter 4, are your investors, I believe, that can pick up the best pieces of real estate, who don't have to compete with owner occupiers in the sense of a hot auction market. And at the same time, a load of your first home buyers have filtered through and they're starting to cool off as well.
That's a really good point. I think the trap that you can fall into here as an investor is you can think you're smarter than you are. No offense to the people that are out there. When you start not you, but like gaming people, you know, people start thinking they're a builder, they're a developer. I'm going to start flipping homes. They start taking outsized gambles on the market. Because
the bank will lend them the money as well.
The bank will lend them the money. The market's starting to move. They've got equity in their own home. So they're a genius. Why don't I just go buy another property? Maybe we should scale up our house and go buy a $2 million home because the market's going to keep on running. So this is when people start to make mistakes. And when you're at an auction and you're competing with an investor, you're competing with a homeowner, you're competing with, you know, a wannabe developer, the prices start to get really silly. And I personally think that this is then the time to be buying fixed price assets.
Most certainly.
You know, if you think that the market's going to run 10, 15, 20% in the next 12 or 24 months, go buy it in today's dollars and settle it in 12 or 24 months when it's worth more than what it's when you bought it for today, rather than getting stuck in a war. You know?
I mean, it can be said if you're buying at an auction and you're competing against someone, you're almost buying. Yeah, you're almost paying for your equity that you could have gained in the next 12 months. You know, it goes, I don't know, 120, 140, 160,000 over reserve. And to say what it should be, the reserve should be a market price for I know it can be very indicative of what the seller would or what the vendor wants. But at the same time, the vendor should have an idea of this is what the market's worth at the moment, and this is what I'm happy to accept on a market going rate. You know, if it goes over 160, over 180 grand over reserve, you know, it's almost it's like you've bought or you've spent away 18, 20% price growth. If you in comparing it to if you bought it at a fixed price or you're buying a fixed price asset.
You know, and on that point, I don't think that these brand new properties will represent extraordinary value going into the future. The reason why I say this is I was reading a report just the other day where the cost of construction is skyrocketing. Wood, to go and find wood, it's getting harder and harder. I want to just quickly put up a report and have a chat about that. So the few things that I noticed was that, wood mills around the world are working at capacity, but the industry has been plagued by labor force issues, beetle infestations due to climate change. And in the US, the price of wood has gone up 400%. That's a huge amount of a huge price increase. In Australia, this is a little known fact that 60,000 hectares of softwood plantations were lost during the bushfires. So it takes 20 to 30 years for us to grow back those trees. That's supply gone. Steel prices in the US have gone up 200%. Prices of iron ore have gone up 120%. These all have larger, longer term implications for the property industry. We need to use wood, we need to use steel, we use iron ore, the price of freight has gone up as well. So getting the materials from China, from wherever we're going to buy it from, it's going up. So, even today, buying something at today's value and it's then going to be built in 12, 24 months, just through the price of construction, the price is going up.
Can you lock in a viewer question, Dom? Can you lock in a fixed price build?
Yeah, you can. Two ways. One, you can just literally sign a fixed price build contract when you build a house and land. You can also, when you're buying stuff off the plan, it is at that price. It doesn't go up because their construction costs go up. If their construction prices go up, then they make less money.
And especially if you're buying something off the plan, Dom, if you're buying, say, you've bought the first of 20 in a boutique townhouse development. You buy the first one, you go, yep, I've checked my boxes. It's got all the right elements for a really nice asset. And then, 6 months down the track, the construction starts and Mr. Developer puts his prices up for the remaining townhouses, 30, 40, 50 grand. So that's it. That's another place where you can see developers are going to always try to make their money. They're always going to try and put money in their pocket. It's a job for them. And, and if construction costs go up, steel framing goes up and everything, and the concrete is jacked their prices up, well, we're going to see the developer, the only real way that he's going to make himself feasible or, his job, put money in his pocket at the end of the day is by putting, every individual townhouse up $10,000, $15,000. And that's just the way, it works.
You're absolutely right. And you know this well, when you're lucky or when you've got early access to sites, developers, builders, they want to sell the first couple kind of at price or just quick. I want to build momentum. I want to get my debt cover. Then they'll keep a portion that they will then use to sell at completion for a higher rate because people will walk into the property and pay more for a property that they can see, touch and feel. It's less risky. So, mate, we're talking a lot about supply and demand. We're talking about interest. We're talking about what's happening in the market. And it feels like we're going to have a strong end to this year. Do you have any other contrarian points of view or do you sort of, you think the same?
No, I think the same. I think that I've said it probably 3-4 times over the past couple of podcasts, but like any investment market, like any market in general, you're going to have correction phases and you're going to have phases where the boom wears off. I don't think we're going to continually to the back end of the year see what we saw in March and April. But going off the blocks that we spoke about this morning, supply and demand and interest rate levels, I think we're going to be able to see a sustainable growth heading towards Christmas. And then I truly feel that we will have another organic push for demand when we come out of the lockdown.
Yeah, agreed.
People will be whether or not this is in 2 months, whether or not this is in 2 weeks, a feeling of freedom and a feeling of let's make a change really can inspire one's want for something else. So I think that organically inside our own economy and our own in property investment market, we're still going to see a sustainable growth. And then as we've spoken about, we've harped on about it, and we've beaten the horse that once international borders open, international migration, international students, and the power of overseas is when we're going to tailor into that second phase of a hard rise.
I'm going to make a prediction here. I'm going to say this, that 3 months from when the Sydney market, when this lockdown ends, we're going to see a spike in prices. Reason why is there are a lot of people that want to buy property that are working in retail, hairdressers, in the retail trade industry that haven't been working, getting a proper pay slip. They need to go and get, 2 to 3 months pay slips before they can get a loan and then buy something. So all of those buyers that are waiting to get back in, get their regular paychecks so they can go get a loan, they're going to need a 2 to 3 month buffer. So I anticipate that if we get out of this lockdown in September, it's probably going to be a January nice little market climb. Everyone's going to go to sleep during the Christmas holidays. It's probably January, February. I think February, we're going to see a big market shift. Now, I'll stop jabbering. We have some client questions here. So let's have a look here. We've got 2 client questions that Jenny's put on the show for us today. Here we go. So first time investor here, Jeff from Sydney says, should I look into investing in Melbourne or Brisbane apartments with $450,000? Louis, what do you think?
Melbourne. Yeah.
Okay.
Can't say it sure enough. I would always, this is my personal opinion. This is from my educated, I won't say educated guess, but an educated opinion that if we're going to go to Brisbane, we've got to get some land. You got to get a piece of land. I don't see a lot of value in the Brisbane CBD apartment story just yet. Not to say I can't be wrong. And as we work our way into the 2032 Olympics with a lot of infrastructure and investment and eyes on the Brisbane market and commitment by the government, I'm sure the apartment game will become a little more closer. But at the same time, if we can go away and spend $450 in Brisbane and get a 4-bedroom, 2-bath, 2-car house, 30 minutes outside the CBD, 30, 35 in an up and coming or even an established community in the south or the north, I think that should be the play. But to answer your question, I think the Melbourne, even though there has been a lot of criticism on the oversupply of the Melbourne apartment market in a CBD ring, I think we can go say 6 to 10 kilometers north in some really, really generational type of suburb. If you're listening in Sydney, Jeff, it would be St Ives or the North Shore line, where you've got a lot of old money and a lot of passed down money and a very, very community safe feeling in that sort of North Shore corridor, moving from Mossman all the way to St Ives. You can find some of those suburbs in the outer skirts of Melbourne, your Essendons, your Ivanhoes, etc., that you can go away and pick up an apartment for maybe a little bit more expensive than that price, but at the same time, value for money wise and return on your investment is going to be, I believe, a lot higher than a Brisbane asset.
Jeff, Louis has said it all, so I'm not going to add any more. I agree 100%. Mate, good chat today. We've covered quite a lot. There's a lot of dense data, so we'll ask Jenny to put the links and things into the comments below. Any parting words of wisdom for our wonderful viewers, listeners out there?
Nothing too much this week. Just keep on your toes. I've spoken to a lot of developers, relationships I have in the north of us in New South Wales, in Queensland, in the south, in Canberra and Victoria. And they're all saying the same thing. The real winners out of this lockdown, your people who are quite savvy on your computer and are taking, the time to really think about where we can put our money. It is a scary time and it is hard to believe, but in saying that, the winners are coming out of this as they've seen, pre-pandemic and then pre or post lockdown last one in the start of last year, and then now the winners are the ones who are willing to look into their investments and to see what they can play with their money.
Agree. For all of you out there, be brave, do your research, start your hunting now. The market's having a relatively quiet moment because it is in this pandemic, but we know it's not going to last forever. So be brave, do your work, partner up with some good people around you. Reach out to me, Louis, the team, and have a wonderful week. Hope to hear and see you all next week. Catch you all later.